At our monthly forecast meeting, we raised our growth forecast for the US significantly from 2.2 to 2.7% for this year. Technically speaking, this is mainly due to the fact that the US economy grew unusually strongly in the second half of last year. This has improved the starting point for the 2026 forecast. The US economy is growing faster than expected for several reasons. First, financing conditions for US companies have improved significantly more than the still relatively high US key interest rate alone would suggest. This is mainly due to the sharp rise in stock prices and the decline in risk premiums for corporate bonds. Both of these factors make it much easier for companies to obtain financing. This has benefited the US economy. Secondly, the tariffs actually paid were lower than Trump's publicly announced tariff increases would suggest. If we compare the tariffs actually paid by US importers to the import volume, the average tariff rate has only risen to just over 10% and not to almost 20% as feared. Many companies were granted exemptions from imports that are difficult to replace by US production. In addition, 80 to 90% of imports from Canada and Mexico are now exempt from tariffs. Because the tariffs actually paid have risen less than feared, inflation in 2026 is likely to be not quite as high as feared. Added to this are the recent falls in oil prices. More growth, less inflation. Overall, we are leaving our US key interest rate forecast unchanged. We still expect the Fed to lower its rates to 2.5% by the end of the year. We anticipate more rate cuts than the futures markets because we take Trump's action against the Fed seriously. The Fed will lose a great deal of its independence if Trump replaces the current Fed chairman, Jerome Powell, with a loyal successor. These are arguments for a weaker dollar and higher yields on US government bonds on trend.